this has been a pretty decent losing streak that we've had. Is there any bottom in sight in your mind?
Well, certainly not a major low. I mean, we just don't have those indications as of yet. We look at things like the monthly overbought, oversold measures, and while they're oversold, we're seeing some kind of retest, and that's really characteristic of a bear market cycle, which, as you know, can be prolonged. So we have no indications yet of a long-term low, but there are some indications still that we're getting into a shorter-term low. I think that these sort of counter-trend rallies are really very difficult to time, and that's because they're very fast and furious, very short-lived, and we saw that, of course, last week with a very explosive two-day up move. But what we have here now for the S&P 500, unfortunately, is a decisive breakdown below the summertime lows. Those weren't major support, but it does obviously show that the downtrend that's been intact year to date still very much has a hold on the market.
If that's the case, let's say hypothetically, I can't do this, but I can do it with futures if I'm a futures trader in E-minis or anything else. Let's say I wanted to put a limit order down below for the S&P 500 E-minis right now. Where would I put it just to see if I could pick some levels to either take a position or build around a new one?
Are you talking about a short-term position?
Sure. Let's talk about a short-term position. Let's see if there's a short-term bounce here that we can
You're forcing me into it, Dom. What I would say is that for the S&P 500 cash, which is where we drive most of our levels, except intraday levels, the support that's most important is roughly 35.05, and that's based on a 50% retracement of the uptrend drawn back to the COVID corrective low. And that's an important support level, but it's just an interim support level in our work. We actually believe that the S&P 500 at some stage during this bear market cycle will reach 3,200, which was a targeted support level from an earlier breakdown. And therein, of course, lies the risk of any kind of counter trend positions. But I would say that sort of 35 area would be a place that would be a natural spot to see some kind of more sustained relief rally unfold. We certainly do have a widespread intermediate term oversold condition about in line with what we saw at the June low. And we do that by tallying up the oversold readings among the constituents of the S&P 500. And it is a very oversold extreme that we have here. But again, we'd rather use that kind of relief rally as a selling opportunity as opposed to put on a counter trend position.
All right. So Kate, so we've focused a lot, of course, on what's happening with the broader markets and the S&P and certainly the 35% pullback in the NASDAQ. But there are other parts of the market right now that are in focus as well. I think about crude oil. I think about a lot of commodities that may signal something about the global economy, maybe even gold prices. Are commodities on your radar right now at all in terms of a possible opportunity for a bottom?
Always. I mean, we look at commodities as they influence equities, and certainly the energy sector this year has been very topical. For crude oil prices, we have seen a very impressive relief rally there. And what we're calling for is a shallow pullback, which is essentially underway, and then a resumed relief rally. We think crude oil may have entered a long-term trading range, just like gold prices have already been in. And yet these sort of intermediate term swings within that context can be quite sizable. So we are looking for some upside follow through in the coming weeks for crude oil, and that should continue to be a boon to the energy stocks, which exhibit positive long-term momentum and relative strength. And they're really the only sector that has that characteristic at this time. For gold prices in particular, again, we've seen really the most significant oversold bounce since the intermediate term downtrend began a few months ago. And we say that because we now have upturns in our weekly measures that suggest that it has a little staying power. So we welcome that relief rally in gold, which has, of course, outperformed the equity market as a bit of a safe haven in this type of environment. But beyond that, we can find uptrends in the ag, so the agricultural commodities, things like corn and wheat. That's a source of long-term uptrends. And as you know, Dom, there's not a lot of those in the marketplace globally right now. So we welcome any opportunity to take advantage of long-term uptrends.
All right. So ag commodities, the soft ones, we'll keep an eye on those. I wonder, Katie, before we let you go, we just got a couple seconds left here. Is there a high conviction short in your mind right now?
We actually are recommending shorting Tesla. And I have to say that because we have a short-term breakdown. It's a significant loss of relative strength that we've seen. And of course, the momentum has deteriorated. And if you take a step back and look at the long-term picture of Tesla, you'll see what looks like a topping formation. So to us, that holds a lot of risk. Maybe not in the very, very near term, but beyond the very near term, we do think that we'll see some additional downside leadership from Tesla.